All right. Good morning, everybody. Good morning, all you magnificent melonheads of the world. Happy Wednesday, everybody. Today is August 26th, 2026. Our top stories this morning, we've got inflation and we've got the consumer, and they are one and the same. First, we got PCE inflation, or personal consumption expenditures. That's the Federal Reserve's favorite method of inflation, or favorite method of measuring inflation. And it came in a little bit higher than last month and a little bit higher than expected. So we got 3.7% year over year. That is up from the 3.6. I'm sorry, that's flat, the same as the 3.7 that we got last month, but slightly higher than the 3.6 that was expected. On a month over month basis, PCE came in 0.2%. That is versus 0.1 that was expected, so higher than we thought on a monthly basis, and up from negative 0.1 last month. So we got headline PCE a little bit higher than expected, a little bit higher than last month. Core PCE came in at 3.3% year over year. That is in line with what was expected and flat. And on a monthly basis, core inflation was 0.2%, in line with expectations, but up from last month at 0.1. So, look, this was showing inflation a little bit higher than we thought, maybe a little bit higher by some measures. Stubbornly high, sticky, they're saying in CNBC. Not exactly a good inflation report. Certainly not a good inflation report, right? We're still over 3%. Remember, the Fed has a 2% target. We haven't hit that in 5 years, but what's your hurry? But on top of that, it's not so bad that it doesn't give the market any kind of clarity as to the direction of the Federal Reserve and an increasingly reticent Kevin Warsh. The market just doesn't really know. I mean, we're going into Jackson Hole later this week. We'll get Kevin Warsh's speech on Friday. Nobody knows what he's going to say or if he's going to say anything at all. Warsh notoriously does not want the market hanging on the Fed's every word, and so he says less. And that's much to the chagrin of Nick Timiraos and the press pool at the Federal Reserve. Now, also included in that PCE report today was personal spending. It rose 0.2% for the month. That is exactly what the inflation rate was, and that is sluggish consumer spending behavior. The consumer's tapped. And you can see that in some of the earnings that we've gotten over the last 24 hours. Case in point, we got Dick's Sporting Goods yesterday, absolutely destroyed, down 30% in a single day. Why was Dick's down? They posted an EPS beat, but the comps were not quite so good at Foot Locker. I remember hearing about the Foot Locker deal with Dick's Sporting Goods last fall when they announced it. And I remember thinking to myself, why the hell would Dick's be buying Foot Locker? Like, is there a warehouse full of solid gold at Foot Locker that nobody knows about? Otherwise, there's no reason to buy Foot Locker because nobody goes to the mall anymore. Nobody goes to Foot Locker anymore. The only reason to go to Foot Locker is if you're trying to recruit officials for the WNBA at some point. I don't know, but nobody's shopping there anymore. And you can see it. The comps at Foot Locker were dreadful, and it destroyed Dick's yesterday. We also got Kohl's reported earnings just this morning. That stock is falling as well. The comps negative 0.9%. That is dreadful. Again, nobody goes to the mall anymore. Earnings per share beat, revenue fell, but the only reason Kohl's got an EPS beat was because of tariff refunds. And market's seeing right through that, punishing Kohl stock this morning as well. So look, take away artificial intelligence and you're left with a consumer-driven economy that isn't really consuming very much. And speaking of artificial intelligence, we've got OpenAI's head of data centers has quit the company, along with several sales executives just announced this morning. These people are adding to the conga line of departing executives at OpenAI. That's about 10 miles long and presumably has Buster Poindexter at the head of it. Why are so many people leaving OpenAI, besides the fact that Sam Altman is an unbearable asshole based on all firsthand accounts? Things not going so well there. You don't see that at Anthropic. You don't see people departing day in and day out. And we'll go through the laundry list of people who's left this company recently. Not good as they're trying to IPO. And speaking of that IPO, SoftBank is in the news this morning. They are about to issue $20 billion of bonds in order to pay back their $40 billion bridge loan, which, if my calculations are correct, that's not enough money. But yeah, $20 billion of bonds. Now, that $40 billion bridge loan, they took that out earlier this year to invest in OpenAI, and they called it a bridge loan, like just short-term financing, because don't worry, OpenAI is going to IPO any day now, and then when we sell into the IPO, we'll be able to raise some money to pay back that bridge loan. Well, here we are 8 months later. OpenAI appears no closer to an IPO than they were in January. Actually, it looks even further away. And SoftBank's like, yeah, about that 40 billion bucks we borrowed and we told you we'd pay back with the IPO. We'll pay you back just as soon as we can borrow another 20 billion from some other schmuck. More junk debt in order to inflate the AI bubble. And keep that in mind this afternoon when NVIDIA reports their earnings. By the way, biggest event of the quarter, NVIDIA's earnings. Keep in mind, whatever revenue numbers NVIDIA reports, and they will surely be dramatically high once again, because NVIDIA is basically handing money to people so they can hand it right back to them. But SoftBank is doing the same thing. All that money that SoftBank borrowed, that they're now trying to borrow in order to pay back what they previously borrowed, all that money was handed right to OpenAI, so OpenAI could lose it. OpenAI does not make money. They are being bankrolled by their investors, SoftBank chief among them, and without that flow of investment capital, OpenAI wouldn't exist, and then OpenAI wouldn't be able to pay for NVIDIA's chips, and NVIDIA wouldn't be able to report those revenue numbers. It's all being propped up by accounting fraud and now debt. Shifting gears a little bit, back on the inflationary thing, we got to talk about natural gas in Europe. We got two articles this morning about that. The Netherlands will not make its storage target for natural gas heading into the winter. It's been in the making for a couple of months. The Europeans have not been buying enough gas to refill their tanks, especially since war broke out in the Middle East. And now the Dutch are coming out and admitting that they're not going to hit their target. They're saying it is not commercially viable to fill the tanks ahead of winter. It doesn't necessarily mean that they're going to run out of gas this winter, but it does mean get ready for higher natural gas prices in Europe. And you can see that in this other article we've got in Bloomberg about how natural gas is now driving long end of the yield curve in European bonds. It's driving interest rates, government borrowing costs in Europe higher, because the biggest input to inflation in Europe is not oil anymore. It's now natural gas. And since those tanks aren't full, everybody's worried about higher gas prices. They're worried about more energy inflation, and so they're demanding higher interest rates to lend money to the government. Natural gas is making a mess in Europe. I'm sure we're going to be talking a lot about that later on this fall and this winter. And last but not least, we've got to talk about LeBron James. This story broke yesterday, and I couldn't believe what I was reading when I saw this. LeBron James apparently sold $300 million of bonds. And what was that bond made of? That bond was made out of securitized future payments from his Nike endorsement deal, which was a huge endorsement deal. It was a lifetime deal. We're valued at almost $1 billion. But the fact is, LeBron James got with, you'll never guess who, Guggenheim, run by Mark Walters, the guy who bought the Lakers and then used insurance money and everything and related party transactions, and now he had to sell the Lakers, and he's desperately trying to raise capital in order to pay it all back and stay out of jail. Yeah, that guy. Mark Walters helped LeBron James turn his endorsement deal into a bond, and he sold it to insurance companies. Now, I've had a lot of people on Twitter yesterday were trying to be like, this is normal. They do this all the time. No, they don't. What are you, drunk? Insurance companies are not supposed to buy this shit. Insurance companies are supposed to buy boring, safe U.S. treasuries because that's grandma's annuity. Grandma ain't trying to get rich. Grandma's just trying to make sure she doesn't run out of money. All right? These are supposed to be low and slow, safe, boring investments, not securitized brand deals from professional athletes. What the hell is going on here? And we got to talk about who bought those securitized brand deals from LeBron James. And look, you know, LeBron James, he's a great athlete. It's a big deal. He's making a lot of money, sure. But there's a lot that could go wrong there. right? What happens if LeBron James gets hit by a car tomorrow? Are people still going to be buying his shoes in 10 years if LeBron James gets hit by a car? What happens if LeBron James gets a DUI and kills somebody, or if he gets drunk and does something stupid? I'm not saying he will. LeBron keeps his nose clean, but professional athletes do this kind of shit all the time. There's morals clauses in these contracts that basically void them if LeBron turns out to be a scumbag, as many of his colleagues are. Again, I'm not saying he is, but that is a tangible risk. And this garbage is being sold to insurance companies. What the hell are we doing? Good God. Guys, we got a lot to talk about today. Why don't we shrink my big melon of a head? Let's see what's going on in the world of finance. Don't forget the like button and the subscribe button for the YouTube algorithm so you can come back tomorrow and have your coffee with the melon heads, because we do this every day. Right now, the S&P is lower by 10 points ahead of the opening bell. You may notice that big red candle there. That was when that PCE came out a little bit hot. It did send stocks a little bit lower, but not tragically so. We've got the Dow is higher by 13 points, 0.02% higher this morning. Again, you can see the lead up to PCE and then the sell-off afterwards. And I say sell-off, I use that term loosely. It wasn't really much of one. And the NASDAQ is lower by 116 points, 0.4% in the red this morning. We've got the dollar is a little bit stronger here, higher by 19 basis points, 99.10. Almost all of that coming immediately following that PCE inflation. So a slightly stronger dollar could be the market saying maybe Kevin Warsh is going to be a little bit more hawkish now. Maybe we're going to get that rate hike. We'll look at the CME futures in a minute, see if that lines up. But stocks lower, dollar stronger. That's suggesting a more aggressive Federal Reserve. We've also got bond yields are moving higher at the long end of the yield curve this morning. The 30-year yield is at 5.182. That's higher by almost 1 basis point. That's after the 30-year yield dropped some 15 to 18 points in the last few days since Scott Bessent versus the world. We've also got the 10-year yield is at 4.658. That's higher by almost 2 basis points, but off the highs that we saw last week before Bessent got involved. The 2-year yield is higher by 1.5 points at 4.220. And the 1 month is at 3.698. That is off by a fraction of 1 point. Looking over at Bitcoin, we are lower this morning, 78,000 even right now, down $500 from yesterday. I got to say, Bitcoin put in a very ugly candle yesterday. That is not good looking. It broke above 80,000, didn't stay there very long, and ended up selling off. I mean, it closed the day just down a few hundred yesterday, but it was a few thousand off of its intraday high. So Bitcoin appears to have run out of steam a little bit here. And look, the RSI has now been over 80 for 5 days. It just never stays there very long. Something tells me this, without another catalyst higher, Bitcoin is probably going to drop here pretty soon. Looking over at the commodities board, we've got spot gold is lower this morning, off by $53. $4,606, 1.1% lower. Gold may be pricing in a more aggressive Fed based on that PCE report this morning. Spot silver is also down 46 cents, or 0.2% at $68.13, but I still like the shiny. Copper is lower by 0.86%. Platinum is higher by 0.25%. Palladium is higher by 0.4%. The PGM metals are a little bit green this morning. And crude oil is off by another $1.68, 2% lower for WTI crude this morning, $80.72. Let's take a look at that oil chart, shall we? Yes, let's. Oil down almost $7 or $8 over the last 3 trading sessions on really nothing. There hasn't been any news. You know, we got this story, look, we got this story. Iran and Oman prepare Hormuz deal as U.S. holds back on secondary sanctions. Nobody cares that Iran and Oman are talking, because if Iran and the United States aren't talking, then it doesn't matter what Tom tells Dick or Harry. As long as the two sides that are at war are not talking, there's not going to be a deal to resolve what's happening in the Strait. So that's not what's driving oil lower this morning. I think what's driving oil lower this morning and over the last 3 days has more to do with something like this that we got on X yesterday from tankertrackers.com. A busy day in the Gulf of Oman where there are at least 15 sets of ship-to-ship transfers taking place. We count 25 million barrels of crude oil plus some refined products. The oil originates from almost every country in the region minus Iran. And what they did is they pulled the satellite data in the Gulf of Oman and they looked at all the examples of ships lined up end to end, as you're showing here in these incredibly grainy pictures. All right. You have got this batch of merchant mariners in the Gulf, and these guys are freaking wild men. And what they do is day in and day out, they just run the gauntlet through the Strait of Hormuz back and forth and back and forth. They don't ship the oil all over the world. They just take the risk, dodge the missiles and drones, and then put it onto another boat, and then that boat takes it to the rest of the world. They're probably operating without insurance, taking a lot of risk. Some of them aren't making it because every day there's another UK MTO warning about another ship getting hit, but most of them are getting through. That's the point here. There's a lot more oil getting out of the Gulf than the Iranians would like you to believe. Let's put it that way. Yes, they're still sinking some and they're still blowing some up, and they are still killing these merchant mariners. These guys, by the way, again, special breed of crazy to do this. But the money is there, and so people are taking the risk. Now, some of these numbers in the tanker trackers post here, like 25 million barrels of crude plus some refined products, I don't think that's 25 million barrels per day. As a matter of fact, it definitely isn't. I don't know how long these ship-to-ship transfers take. I'm guessing the actual daily amount is just a fraction of that, but it's a good bet. We probably have somewhere between 5 and 10 million barrels a day of crude oil is getting out of the Strait. It's not the 20 million that we had before the war started, but it is enough to keep oil in the 80s, threatening to take it down into the 70s. All right, now let's talk about PCE. Again, we'll go through the numbers here. We've got 3.7% year over year for PCE. That's your headline number. Flat versus the June number, which was well off of the highs that we saw in May. And again, this is predominantly oil that has this trading sideways here. We did have a decline in oil prices after the memorandum of understanding. There's been some volatility ever since. Oil's currently trending higher, but as far as July goes, in line with expectations. Well, it was a little bit higher. The market was expecting 3.6. It was a little bit higher than that, but flat versus the prior month. On a month-over-month basis, though, it shows PCE inflation has reaccelerated. We did go negative in June. We were negative 0.1 because of the deal or no deal with the Iranians. That brought oil prices lower. And then, of course, the shooting started up again in July. So on a month-over-month basis, we came in at 0.2. Market was looking for 0.1, so it was a little hotter than expected and up from last month. The core number, the core stubbornly high here, 3.3%. Other than that 3.4 that we got in May, we've been here pretty much for most of this year. Core inflation on a year-over-year basis is stuck in the low threes. And again, the target is 2. Right? They tell us that we're going to get 2. Any day now, we will deliver price stability for the American people. It's like one of the few things Kevin Warsh says. Well, Kevin, we're waiting. Meanwhile, on a month-over-month basis, core PCE came in at 0.2%, again, higher than we were in June, and that was in line with expectations. So one more thing I want to talk about, this one from Craig Fuller on the inflation front here. TD Cohen freight brokerage insurance costs up 3x in post-Montgomery world. And when he's talking about in post-Montgomery world, Montgomery versus, I think, Caribe was the other name in the court case. This was a case where a trucker lost his leg in an accident because he got rear-ended by some dirtbag trucker from some low-budget carrier who crashed into him when he was pulled over on the side of the road, almost killed him. And he sued the broker who hired that carrier. And that was a big Supreme Court case earlier this year where the Supreme Court ruled unanimously, by the way. It was 9-0. Since when did they 9-0 on anything at the Supreme Court these days? But it was 9-0. They ruled that the carrier is liable and the broker is liable as well, that you can sue the guy who brokered the transaction because all they were doing was going with the lowest bidder. They were hiring guys with lousy safety records just because they were underbidding the safer competition, creating hazardous conditions on the road, and this guy lost his leg because of it. Well, the Supreme Court ruled that the brokers are liable. So now the broker has to factor in the safety record of the carriers that they're hiring. And that also meant the insurance costs for the brokers went sharply higher. And TD Cohen did this analysis here. They're saying after this decision, there's, top 10 freight broker saw a 3x year-over-year increase in their recently renewed auto liability insurance. and that there are only 10 underwriters involved in broker auto liability. That will likely decrease over time, which means insurance companies are getting out of this business because it's very hard to measure the risk. The ones who are staying are wildly increasing their premiums. This is on top of sharply higher diesel prices and the crackdown on non-dom CDLs, meaning there's limited trucker supply available. Because of that, all of these things are factors that are driving the cost of moving goods higher in the United States. And that is also going to put upward pressure on inflation. All right, now after all this inflation data we got today, let's see what the CME Group is telling us about the prospects for the Fed. They're pretty much unchanged. Yesterday, it was 60-40 that they do nothing. Today, it's 60-40 that they do nothing. By the way, usually this close to an FOMC meeting, you typically get one is a lot bigger than the other. The market has typically made up its mind about whether the Fed is going to act or not in either direction as you get closer. Now, they don't know, because Kevin Warsh is not giving them any direction. And that is by design. Kevin doesn't want the market trading on what they think the Fed is going to do. Kevin wants the market trading on the fundamentals. Well, Kevin's getting what he wants. And the last of the PCE data, we got U.S. personal spending increased by $36.3 billion or 0.2% in July of 2026 from the previous month. That 0.2% you can see here on the chart, that is anemic consumer spending growth, just keeping pace with the rate of price increases. And that's kind of a good segue into these two stories here. Dick's Sporting Goods stock falls 30% as retailer misses expectations and cites challenging footwear market. People can't afford shoes. Dick's Sporting Goods on Tuesday reported quarterly earnings that missed Wall Street expectations and lowered its outlook for Foot Locker amid what it called a challenging athletic footwear and apparel marketplace. Dick's stock fell 30% in trading on Tuesday, its worst day since 2023. The company said Dick's stores saw a 4.9% increase in comparable sales for the quarter, driven by broad-based growth across categories, including strong results from the World Cup. However, Dick's said Foot Locker saw comparable sales decline by 3.6%. That is dreadful, leading the company to revise its full-year outlook for the Foot Locker business to a range of flat to down 2%. It still expects the Dick's business to grow between 2.5% and 4%, but the company lowered its overall net sales outlook for the year from a range of $22.1 to $22.4 billion. That's from a range of 21.9 to 22.2. I'm sorry. They lowered from 22.1 to 22.4 to 21.9 to 22.2. So they dramatically lowered their operating income outlook for the year. The company also said it received $59 million in tariff refunds during the quarter and $2.1 million in related interest income. The earnings come as Dick's is in the midst of implementing a turnaround for Foot Locker, which has previously weighed on the company's bottom line. Dick's has sought to refine Foot Locker's strategy to return to growth, especially at a time when sportswear is booming. Dick's acquired Foot Locker for $2.4 billion in 2025 for some reason, saying at the time that it planned to use the deal to expand its international presence and better position itself against its competitors. Thou shalt not buy mall stocks. You think the people at Dick's Sporting Goods would have understood this. The mall is dead and it is continuing to die. All right. There's nothing in malls anymore but medical offices, and I don't even know. I haven't been in a mall in years, and the last time I actually went to a mall was to shoot a video about how there was nobody at the mall. So, yeah, Dick's Sporting Goods down. It was down 30% yesterday. You can see that decline. This is a 5-day chart here. Down another 1.25% today, off by 35% just over the last 5 days here, $122.65 for Dick's Sporting Goods. And still on the consumer and the mall stock thing, Kohl's falls despite an earnings beat and raised guidance. Kohl's Corporation reported second quarter results that exceeded earnings expectations and raised its full-year outlook, but after initially rising, shares are now down 8% pre-market on Wednesday. The retailer posted adjusted earnings per share of $1.28 for the second quarter, beating the consensus of 57 cents by 71 cents. That's a huge earnings beat, but earnings quality matters. The revenue of $3.32 billion fell short of the $3.4 billion analyst estimate and declined by 0.9% year over year. How do you get a revenue miss and still beat your earnings by such a huge amount? We'll see in a second here. Comparable sales also decreased by 0.9% for the quarter. That is dreadful. Gross margins expanded 305 basis points to 43%, aided by approximately $100 million in tariff refunds that flowed through gross margin during the quarter. And that's how you get a big earnings beat on a revenue miss, $100 million in tariff refunds, which, by the way, it turns out the tariffs that we paid last year was really just a transfer of wealth from consumers to corporate earnings. Now that the money is being refunded by the government to the companies certainly aren't refunding that money to the consumers who paid them. But I digress. The market sees through this. All right. When you report an earnings beat because of a tariff refund, the market doesn't care and they punish your stock. The company raised its full year 2026 adjusted EPS guidance to a range of $1.80 to $2.40 with a midpoint of $2.10. That significantly exceeds the analyst consensus of $1.43. Again, is being driven by tariff refunds. Kohl's expects full year net sales and comparable sales to decline between 1.5% and flat. The company also announced it's restarting its share repurchase program with up to $100 million in buybacks planned for 2026. If you're buying back stock while your comparable sales are in free fall, that means you have no good ideas to turn around your business and you're just hoping to stop the bleeding in your share price. This is dead money here. Kohl's is down 8.5%, $16.15, off by $1.54. Meanwhile, OpenAI's head of data centers has left the company. Man, people just don't seem to stick around very long at Sam Altman's AI startup. Chris Malone joins a string of recent high-level executive departures as the AI giant heads towards an IPO and ramps up its spending on computing power. Don't worry, guys. It's just the fact that senior leadership seems to be leaving in droves at this company that literally the entire economy is being held up by. I'm sure that'll be just fine. A key executive overseeing OpenAI's data center build-out, Chris Malone, left the company last week, according to people familiar with the matter, joining a wave of leadership departures ahead of a planned public offering. Malone joined OpenAI as head of data centers in March of 2025, shortly after the company announced Stargate, an ambitious effort with Oracle and SoftBank to build data centers to meet its rapidly growing compute needs. This guy was only on the job for less than a year and a half. The Stargate effort got off to a rocky start, and OpenAI shifted towards signing deals with cloud providers rather than developing facilities itself. OpenAI is now reviving some of its internal data center efforts through projects in which it leases entire facilities rather than simply renting chips from cloud providers. But other leaders are heading that effort, not Malone, some of the people said. His departure comes amid a broader exodus at the firm, which is working towards an IPO that's expected in 2027 and racing to catch up to rival Anthropic in sales to business customers. In recent weeks, Chief Revenue Officer Denise Dresser, Chief Operating Officer Brad Lightcap, and Fiji Simu, who served as the second in command to CEO Sam Altman, have all left the company. And there's another article in the information this morning about sales executives leaving OpenAI this morning, more than a dozen, as the information is reporting, all heading back to Salesforce, where they were poached from. Things at OpenAI don't seem to be going so well here, guys. You'd never guess looking at the NASDAQ. You'd never guess. You can guess by looking at SoftBank, though. I tell you, when I saw this headline this morning, the first thing I thought was Neil Patrick Harris putting his hand on the brain bug saying, it's afraid, it's afraid. SoftBank mulls up to $20 billion bond sale for OpenAI stake. And it's not just for an OpenAI stake, though. SoftBank is talking with investment banks about a potential $10 to $20 billion bond offering to help refinance a loan for its investment in U.S. tech giant OpenAI, according to people familiar with the matter. The offering could be denominated in dollars and euros and could come as early as September, said the people who asked not to be identified discussing private matters. The talks are still ongoing and details could change. SoftBank is borrowing money from anyone that will lend it to them. These guys are going nuts. Proceeds from the sale would partly be used to repay a $40 billion bridge loan secured earlier this year for its OpenAI investment and also for other AI investments, the people said. Junk-rated SoftBank, founded and led by millionaire Masayoshi Son, is slated to invest close to $65 billion in OpenAI by October, funded in part by loans. All right, so that $40 billion bridge loan, they took that out earlier this year. And the whole point of that is like, it's just short-term financing. It's just to hold me over until the IPO. Here we are 8 months later. Oh, shit, the IPO is not going to happen until next year if we're lucky. So what do? Well, we issue bonds to pay back the loan, take on new debt to pay off the old debt, send a few billion more over to OpenAI while we're at it, because why not? Remember, this is the company that is holding up the entire AI bubble, OpenAI. The bond sale would add to a slew of fundraising by companies looking to deepen their reach into artificial intelligence, despite concerns about growing credit risks and whether these investments will actually pay off. Some firms are turning to junk bond investors for AI-related funding, even for debt that is investment grade, as competition for capital heats up. And that, I pounded the table on that the other day, that firms are turning to junk bond investors for AI funding, paying junk bond interest rates for debt that is being rated as investment grade. And that tells me the ratings agencies are not adequately measuring the risk associated with these bonds. For whatever reason, they're calling them investment grade just because AI is awesome. Trust me, bro. And so they're selling investment grade debt. And because it's investment grade, it means mutual funds, insurance companies, all funds that typically wouldn't be allowed to buy junk are allowed to buy this stuff. Again, we can all see what's happening here, right? I mean, it's so obvious at this point now. Do I need to put my tinfoil hat on again? We haven't worn this in a while, because it's not a conspiracy theory anymore. It is the inconvenient truth that has been sitting on the faces of this market for years now. This is wasted money. AI is not going to generate a return. These data centers will be useless in years. And yet we're still borrowing hundreds of billions of dollars from grandma, from 401ks, IRAs, and pensions in order to pay for this crap. This is going to end horribly. When it happens, just remember, nobody saw this coming. Meanwhile, the Dutch will miss their winter gas storage filling target. Gasuni warns? I don't know. I'm sure I said that wrong, but this guy warns. The Netherlands won't meet its target for filling gas storage facilities before this winter, leaving the country ill-prepared for particularly cold conditions or unexpected supply disruptions, according to network operator Gasuni. Don't worry, there are no unexpected supply disruptions anymore, because we're all expecting them. Now, there will be supply disruptions because everybody is blowing up supply and infrastructure all over the place. Gasuni warned the country will miss its target of 115 terawatt hours, as it's not commercially viable to fill gas storage facilities this summer. Translation: we can't afford to fill the tank. Dutch gas storage sites are currently about 45% full, the lowest in records going back to 2009 and way below a 5-year average of 73%, according to data from the industry group Gas Infrastructure Europe. And just look at the relentless optimism here. Gas storage in the Netherlands is 45% full. You might forgive a guy for thinking a 45% full storage tank is actually 55% empty. All right. I don't know. I mean, look, I'm the doomer. I'm the pessimist. I get it. I get the comment, dude, you're so negative. How come you're never positive? All right. 45% full. There you go. There's optimism. It's the best I can do. The target is based on the amount of gas required to cope with the harshest winter of the past 30 years. Missing it does not automatically mean there will be insufficient gas available for coming winter, or that security of supply is at risk, according to Gasuni. Again, yeah, we're not going to go to zero. That never happens. The tanks never actually go to zero. What happens is the prices rise, and price theoretically approaches infinity as the needle approaches zero. So the point is, how many people can afford gas, because it gets so scarce that the price rises so much that people stop using it. Or if they follow the European model, they'll just subsidize the shit out of it and people will use it, and then they actually do hit zero. But I can tell you, this has caught the attention of the bond market this morning. Natural gas eclipses oil as key inflation risk for European debt. Natural gas has overtaken oil to become the biggest concern for European bond traders, as depleted supplies of the key fuel threaten a resurgence in inflation. European gas prices are near 5-month highs, and winter contracts cost more than twice as much as they did a year ago. Yields on 10-year German and UK debt have touched levels not seen in decades, even as Brent crude trades 30% below the peak hit at the back of the Iran-US war. Investors are concerned that rising gas prices will reignite inflation, forcing central banks to increase interest rates more aggressively than markets currently expect. Gas plays a central role in the region's economy, accounting for 21% of the EU's energy mix, between 25 and 35% for the UK. The natural gas price is more relevant to the UK and Europe and never really recovered in any of the ceasefires and continues to leg higher, said Emma Moriarty, portfolio manager at CG Asset Management. The firm has boosted the position of inflation-linked government bonds in its flagship multi-asset fund to a near record 49%, prompted by the risk of sustained price pressures. Bond yields have spiked on other worries too, including unsustainable public finances, a flood of borrowing by hyperscalers, and unpredictable U.S. policymaking. But market participants say gas is now the biggest energy-related risk to the outlook for European and UK interest rates, even though prices remain well below highs hit after Russia invaded Ukraine in 2022. Natural gas prices have taken over as the key driver of yields, said Jamie Searle, European rate strategist at Citigroup. Since the beginning of July, duration has continued to track natural gas prices and paid somewhat less attention to oil, he added, pointing to the correlation of the benchmark 10-year bonds and the price of natural gas. You can see it here. In orange is the price of Dutch TTF gas futures, and in black is the German 10-year Bund yield. You can see they're trading pretty much in lockstep. Natural gas is now driving interest rates in Europe, and they don't have enough of it. The Dutch have not filled the tanks because they can't afford it, because it's not commercially viable. And here is your Dutch TTF natural gas futures, 64.88. That's in euros per megawatt hour. And you can see we're right back up here, right around the highs that we saw at the outbreak of war back in March. Oil trading much lower than the highs we saw at the peak of the Iran war, but natural gas is still up at those levels. Now, we'll also temper that enthusiasm a little bit. We are going to zoom way out on this chart. And so you can see it. I actually have to change the measurement here to align. You can see now nowhere near levels we saw in 2022. But I would add the only reason they didn't run out of gas in Europe in 2022 was because they had a mild winter. They had several mild winters. They were really worried about missing or running the tanks empty in that winter immediately following the Russian invasion. So prices nowhere near those levels that we saw, but now European inflation is more keyed to those prices. Bond yields are rising along with gas prices. So God forbid we get back up here again this winter. What would happen to European interest rates? Yikes. Last but not least, shaking my head. I know I ranted about this one at the beginning, but LeBron James borrowed $300 million from insurers arranged by Guggenheim. And keep in mind, that is Guggenheim, owned by Mark Walters, the guy who just sold the Lakers and the Walters Group, and the guy who was under federal probe for failing to disclose related party transactions. In other words, fraud. Now it involves LeBron James. When LeBron James signed up to lead the Los Angeles Lakers to NBA glory with a $154 million contract in 2018, it wasn't the biggest deal he had that year. Just months before he joined a limited liability company that he controls, borrowed almost $300 million from a pair of Midwestern life insurers advised by an arm of Guggenheim Partners, according to insurance industry records reviewed by Bloomberg. And again, Guggenheim Partners, that's Mark Walters' outfit. The previously unreported bonds, which are due in 2049, were structured to provide immediate cash to James and backed by a stream of future revenue tied to his earnings outside of basketball, such as a lifetime Nike sponsorship, people with knowledge of the matter said. The burst of lending began before Guggenheim leader Mark Walters started acquiring the storied basketball team. In an abrupt turn this month, the billionaire mogul agreed to sell the Lakers amid a federal probe into parts of his business empire. There's no indication that the loan to James have anything to do with those inquiries, other than the fact that it involves the same individual and the same companies and the same basketball team. Athletes and artists are increasingly using future earnings like royalties and licensing deals to structure deals that help them unlock immediate capital. David Bowie was famous for the first recording artist to go to Wall Street to tap future earnings on his music, paving the way for a thriving market for esoteric securities. They're trying to make it sound like this is normal. It's not, all right? This is to sell this crap to insurance companies is grossly irresponsible. If you're a hedge fund and you want to invest in this shit, no problem. Leave grandma's annuity out of it, though. James's deal offers another look at how Walter and fellow Wall Street money managers have tectonically shifted the once boring business of life insurance, steering policyholder premiums into more unusual investments. Guggenheim has moved insurers' money deeper into private credit, sports franchises, and with James, financing for a star player. That's far outside the industry's traditional focus on plain vanilla assets to reliably pay out future claims. The two insurers, North American Company for Life and Health Insurance and Midland National Life Insurance, are both owned by Salmons Financial Group. Pay attention to that name, Salmons Financial Group, because that's the Alameda Capital or the Alameda Research to this Walters Group, Guggenheim, FTX, if you will. Salmons Group is one of the largest shareholders in Guggenheim. And so this is a related party transaction. These two insurance companies are controlled by Salmons. They're buying the bonds that are being sold by Guggenheim, collateralized by LeBron James's deal. I think we're probably going to hear a lot more about this. And also, when Guggenheim does transactions with Salmons, Guggenheim reports it in their disclosures as a related party transaction. But according to research by Hunter Brook Media, Salmons does not report transactions with Guggenheim as related party transactions. How can I be related to you, but you not be related to me? I don't know how that works, but this deal stinks to high heaven. And look, there's nothing against LeBron James personally. They dangled money in front of him and he took it. But this is risky. There are morals clauses in these endorsement deals. If LeBron James does something that destroys his reputation, the value of this contract goes to zero overnight. If LeBron James dies in a helicopter crash like Kobe Bryant did, the value of this contract doesn't go to zero, but it goes down sharply. His heirs would inherit the deal and still be able to pay into the bond. But 10, 15 years from now, people are not going to be buying LeBron James sneakers if something happens to him tomorrow. There's a lot of risk here. And this is insurance money. It's supposed to be safe. It's not supposed to be put into shit like this so that these billionaire a-holes can do CJs about their NBA sports teams and the players that they're buying with other people's monies. And I better stop before I say something that gets me in trouble with the moderators. Yeah, I saw that one yesterday and I was shaking my head. And to all these imbeciles who are on Twitter saying, like, this is normal, this happens all the time. No, it most definitely effing does not. Maybe people are out there securitizing bullshit, but selling it to insurance companies is new and it is unbelievably sleazy and it's not fair. They're not supposed to do that with grandma's money. Grandma's trusting them. She's accepting a very low yield on her annuities or whatever she's doing in exchange for safety. And they're not putting that money into a safe place. They're putting it into this garbage. Anyways, I just want to say thank you very much, everybody, for having your coffee with the Melonheads this morning. Don't forget the like button, the subscribe button, the hype button, all the buttons. It really helps me out if you feel so inclined. Thank you also to my magnanimous Melonheads on YouTube members, Patreon, and Buy Me a Coffee for supporting the channel. You guys rock. Links down below. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time. Live small and dream big.